Imagine waking up every morning a little bit richer without having to do anything extra. Sounds like a dream, right? What if I told you that this could be your reality? You can grow your wealth while you sleep through the power of passive investing. Passive investing is a simple, stress-free way to make your money work for you. In this video, we will show you just how easy it is to get started. You don't need to be a financial expert or spend hours glued to the stock market. We'll break down everything you need to know. By the end of this video, you'll see that investing can be simple and you can start building wealth today with little effort. So sit back, relax, and let us show you how you can make money while you sleep. The stock market is a place where people buy and sell shares of companies. When you buy a share, you own a small part of that company. Companies sell shares to raise money for their business, and in return, investors like you can make money if the company does well. The value of shares goes up and down based on how well the company is doing and how much people want to buy or sell those shares. Think of it like a marketplace, but instead of goods, you're buying pieces of companies. The power of compounding. Compounding is like a magic trick for your money. It's when your earnings start earning their own earnings. Here's how it works. Imagine you invest $100 and it earns 10% interest in a year, so you have $110. The next year, you earn 10% not just on your original $100, but also on the $10 you earned last year. Over time, this makes your money grow faster and faster. Albert Einstein called compound interest the eighth wonder of the world because of its powerful effect. By understanding these basics, you're already on your way to becoming a savvy investor. Together, these concepts form the foundation of successful investing. Getting started with passive investing. Index funds and ETFs. Index funds and ETFs, exchange-traded funds, are two of the best tools for passive investing. They allow you to invest in many different stocks or bonds all at once, which means you're not putting all your money into one company. This is called diversification, and it helps reduce risk. For example, an S&P 500 index fund lets you invest in 500 of the biggest companies in the US without having to buy each stock individually. These funds have low fees and are easy to buy through most investment accounts. Automated investing platforms, robo-advisors. Robo-advisors are like having a personal financial advisor, but they're automated. They use algorithms to manage your investments based on your goals and risk tolerance. All you have to do is answer a few questions about your financial goals and how much risk you're comfortable with, and the robo-advisor does the rest. It will pick the right investments for you, monitor your portfolio, and make adjustments as needed. Popular robo-advisors like Betterment and Wealthfront are known for their low fees and user-friendly platforms. Why choose passive investing? Passive investing is perfect for people who don't want to spend a lot of time managing their investments. It's simple, low cost, and has been proven to work well over the long term. This means you can spend less time worrying about your investments and more time enjoying your life, all while your money works for you. Starting with passive investing is easy and accessible. You can set up a solid investment strategy that runs on autopilot. Building your passive investment strategy. Before you start investing, it's important to set clear financial goals. Ask yourself what you want to achieve with your investments. Do you want to save for retirement, buy a house, or build an emergency fund? Having specific goals helps you stay focused and motivated. Goals can be short-term, like saving for a vacation next year, or long-term, like saving for retirement in 20 years. Knowing your goals will help you choose the right investments. Everyone has a different comfort level with risk, known as risk tolerance. Some people are comfortable with the ups and downs of the stock market, while others prefer more stable investments. Understanding your risk tolerance is key to building a strategy that suits you. Asset allocation is how you divide your investments among different types of assets, such as stocks, bonds, and cash. Stocks are generally riskier but offer higher returns, while bonds are more stable but offer lower returns. A common strategy is to invest more in stocks when you're young and gradually shift to bonds as you get closer to your goal, such as retirement. This way, you can maximize growth while you're young and reduce risk as you age. Regular contributions and dollar cost averaging. One of the best ways to grow your investments is to make regular contributions. This means setting aside a fixed amount of money to invest each month. Regular contributions can help you take advantage of dollar cost averaging. This strategy involves buying a fixed dollar amount of an investment regularly, regardless of its price. Sometimes you'll buy when prices are high and other times when prices are low, but over time, this evens out and reduces the impact of market volatility. By setting financial goals, you can build a strong passive investment strategy. This approach helps you stay on track and grow your wealth steadily over time, making investing simple and effective. Letting your investments work for you. The importance of patience and long-term thinking. Investing is not a get-rich-quick scheme. It requires patience and a long-term mindset. The stock market can go up and down, but over time, it has historically gone up. This means you need to stay calm during market downturns and avoid the temptation to sell your investments out of fear. Instead, focus on your long-term goals and remember that time in the market is more important than timing the market. The longer you stay invested, the more your money can grow. Rebalancing your portfolio. Rebalancing is an essential part of maintaining your investment strategy. Over time, some of your investments will grow faster than others, which can change your asset allocation. For example, if stocks perform well, you might end up with a higher percentage of stocks in your portfolio than you originally planned. Rebalancing means adjusting your investments to get back to your desired asset allocation. This could mean selling some stocks and buying more bonds or vice versa. It helps you manage risk and stay aligned with your investment goals. Many robo-advisors automatically rebalance your portfolio for you, making this process even easier. Letting your money grow. Once you have a solid investment strategy in place, it's time to let your money grow. Avoid checking your investments too often, as this can lead to unnecessary stress and impulsive decisions. Instead, trust in your plan and let your investments work for you. This way, your investments can truly work for you, even while you sleep. Dealing with market volatility. Market volatility is a normal part of investing. Prices of stocks and other investments can go up and down quickly. It can be scary to see your investments lose value, but it's important to stay calm and not panic. Remember, the market has always recovered from downturns in the past. Stick to your long-term plan and avoid making impulsive decisions based on short-term market movements. If you feel anxious, remind yourself of your goals and why you started investing in the first place. Many new investors make mistakes that can hurt their returns. Here are a few common pitfalls and how to avoid them. Chasing performance. It's tempting to invest in the latest hot stock or fund, but this often leads to buying high and selling low. Instead, stick to your diversified portfolio and long-term plan. Ignoring fees. High fees can eat into your returns over time. Choose low-cost index funds, ETFs, and robo-advisors to keep more of your money working for you. Lack of diversification. Putting all your money into one stock or investment is risky. Diversify your portfolio to spread risk and increase your chances of success. Investing requires discipline and patience. It's easy to get distracted by market news and trends, but the best strategy is to stay focused on your goals. Regularly review your investments, but avoid making changes based on short-term events. Trust in your plan and give your investments time to grow. Start your investment journey today and enjoy the peace of mind that comes with knowing your wealth is building, even while you sleep. Now, if you want to learn how to achieve financial success, then watch this video next. And if you made it to this point of the video, please like and subscribe to the channel to see more content like this. Thanks for watching, and I'll see you in the next video.